Welcome to Ease of Education, where knowledge meets purpose. Before we start, let me tell you why this channel exists. We're not just looking for quick fixes. We crave connection, meaning, and growth. That's why we created Ease of Education, to give you more than a summary. To give you the full emotional and intellectual journey. Let's grow together, one powerful book at a time. In a world where financial literacy can unlock the doors to freedom and opportunity, Learn to Earn stands as a powerful guide for anyone ready to take control of their financial future. Written by the legendary investor Peter Lynch, along with financial writer John Rothschild, this book breaks down the essentials of business and investing into simple, engaging lessons that anyone, even a complete beginner, can understand and apply. Peter Lynch, the brilliant mind behind the incredible success of the Fidelity Magellan Fund, didn't just make history by achieving one of the highest returns in Wall Street's history, he made investing approachable. His philosophy of invest in what you know empowers readers to recognize opportunities in their everyday lives. With Learn to Earn, he inspires young adults and new investors to think critically, stay curious, and take charge of their financial journeys. More than just a book, Learn to Earn is a mindset. It's a call to action to understand the world of business, believe in your potential, and build a future where your money works for you. You've been told countless times how education can change your life, how degrees and skills lead to better jobs and bigger paychecks. And yes, that's true. But here's what most people never tell you: even a great salary has limits, unless you learn how to invest. No one told you that your money can work for you while you sleep. That investing can turn a decent life into a dream life. That with the right financial mindset, you could build wealth, start your own business, travel the world with your family, and finally say yes to the passions you've been putting off for years. So why don't we? Because we were never taught. Schools taught us math, but not how to find winning stocks. We learned to budget, but not how early investing multiplies wealth. We were trained to get jobs, not create them. We admired leaders, but weren't shown how to fuel our nation's growth ourselves. Investing is the missing piece. It leads to financial freedom, equal opportunity, and a life where you call the shots, regardless of your background. It's time to stop just working for money and start making money work for you. 2. Basis of stock market. What is meant by company? When people join forces to do business, they form a company, or more formally, a corporation. The word comes from the Latin corpus, meaning body, symbolizing how a company becomes a single legal entity once registered. It can receive legal notices, face penalties, or qualify for subsidies. Just like a person, there are two main types of companies: private and public. Private companies aren't listed on the stock market. Most businesses fall into this category, and investing in them typically requires being a founder or having direct connections. On the other hand, a public company is open to all. Once it's listed on the stock exchange, anyone can buy its shares and become a part owner. That's the power of the stock market. It turns opportunity into access. World's first stock market. By the late 1600s, global trade surged, fueling the rise of entrepreneurs and the need for royal licenses to do business. Once licensed, traders cleared land, grew tobacco, and sought financing, sparking the birth of the stock market. In 1602, the Dutch bought the world's first stock, United Dutch East India Company, traded on a bridge over the Amstel River. Investors funded ships to India, some even bet against the company, unknowingly inventing short selling. The company thrived, shares doubled, and dividends were born. This marked the beginning of modern capitalism, driven by vision, risk, and bold investment. World's first indicator. In 1884, journalist Charles Dow revolutionized market tracking by averaging the closing prices of 11 key stocks, creating the first stock index, the Dow Average. First published in the Customer's Afternoon Letter, it set the standard for stock market indicators worldwide, inspiring indexes like India's Sensex and Nifty. The first step of which is to find a good investment option. The author explains in detail about 5 basic investments. out of which we will only talk about stocks in detail. First, safe but slow. Banks, FDs, treasury bills, and money market funds keep your money secure, but often offer returns lower than inflation. Second, collectibles, rare items like old coins or signed memorabilia can sell for a premium, if you know what to hold and when to sell. Third, real estate, high returns, but needs big capital. Want in with less? Start as a property agent. Fourth, bonds, companies or governments borrow from you and pay back with fixed interest. Low risk, steady returns. Fifth investment option, stocks, your gateway to wealth. Stocks aren't just an option, they're your smartest move. Unlike FDs or bonds, where you're just lending money, buying stocks makes you a part owner of the company. You share in its growth and its profits through dividends. And the best part? Stocks can't be stolen, and you don't need to be rich to get started. Even without capital, you can train yourself. Start with paper trading, track hypothetical investments, practice strategies, learn from mistakes, and sharpen your instincts before risking real money. When you're ready, think long-term. Historically, smart stock investments double every 7 to 8 years. As your skills grow, that timeline can shrink. And don't fear being wrong. Even legends like Warren Buffett aren't perfect. If you pick 10 stocks, a couple might lose, but if just 2 to 3 become big winners, they can cover the rest and still bring profit. Stock investing isn't just about money, it's about mindset, mastery, and multiplying your future. Ready to start your journey? You don't need a fortune to build one, just a few good stocks can skyrocket your wealth. Think about it, if you invest just $1,000 and triple it, that's $3,000. Now imagine starting with $10,000, triple it 5 times and you're sitting on $2.4 million. Do it 10 times. That's $590 million. Do it 13 times, and you could be the richest person in your country. It's not about having a lot, it's about making smart moves, staying consistent, and letting compounding work its magic. All it takes is one great decision at a time. If you want to grow your wealth through stocks, the first step is simple: learn how to pick the right ones. And there are 5 common ways people do it. 1. Guessing. Some people just go with their gut. They buy a stock because it sounds good or looks cheap. Honestly, that's the worst way to invest. 2. Tips from friends or relatives. Hey, I heard this one's going up. Sounds familiar? The problem is, there's usually zero research behind it. 3. Expert recommendations. Watching business news or interviews can help. But these days, a lot of those expert tips are paid. So, take them with a grain of salt. 4. Broker advice. Full-service brokers have research teams and can guide you. Discount brokers just give you the app to buy and sell. Both have their place, you just need to know what you're using. 5. Do your own research, and this, hands down, is the best approach. When you study, understand, and invest based on your own goals, you're in control. You're not guessing, you're growing. Start by doing your own research and align it with your goals. Let's break it down in 2 powerful ways: practical and analytical. In practical method, you'll look at company in 2 types of views. First, practical insight. Think like an insider. If you're in the medical field, explore companies making tools, top-selling pharma brands, or devices you use daily. In education, look at publishing houses and edtech firms. Your work connects you to potential goldmines, pay attention. Second, customer perspective. Visit showrooms of the companies you're eyeing. Watch how staff engage, observe footfall. No physical access. Go online, check product reviews, ratings, and customer feedback. Compare with competitors. What sets them apart? What's their edge? The goal is to spot real value, not just hype. Invest where you see quality, demand, and potential. In analytical method, first of all we'll analyze stock page and then balance sheet of the same stock. Step 1. Start with the stock page. Wherever you are in the world, whichever app or platform you use, stock pages follow the same core structure. When you open one, you'll see the current stock price and the return over the past year right at the top. But the real gem? Market capitalization. So, what's market cap? It's just the stock price multiplied by the total number of shares available in the market. Let's say a stock is trading at $9, and there are 1 million shares. That's $9 million in market cap. Simple, right? Now, based on market cap, companies fall into 3 categories. Small cap, less than $2 billion. These are the up-and-comers. They're risky, but this is where many future multi-bagger stocks are born. If you're looking for explosive growth, this is where it often starts. Mid-cap, $2 billion to $10 billion, a solid middle ground. Less risky than small caps, but still offer great growth potential. Large cap, more than $10 billion. These are your blue-chip giants. Safe, stable, and reliable. They won't double overnight, but they're great for building long-term wealth. After market cap, take a quick look at the company's business summary. It only takes a moment, but knowing what the company actually does can give you powerful insight before you dive deeper. Step 2. Dive into sector analysis. Before investing in any stock, take a moment to zoom out and analyze the sector it belongs to. It might take a little extra time, but it gives you an edge over 90% of investors. Here's why sector analysis is a game changer. 1. Spot market trends. Early sectors move like waves, some rise faster due to economic shifts. If you can catch the current early, you ride the wave before the crowd. Example, after vaccine news broke, healthcare stocks soared, even during the COVID crash. 2. Manage risk smarter. Every sector has its own level of risk. Knowing this helps you protect your investment. Oil and gas. Volatile. Healthcare. More stable. 3. Pick the winners. When the market rises, most stocks go up. But only a few outperform their peers. Sector comparison helps you spot those standout stocks, and back the future leaders. 4. Discover hidden gems. Once you understand what it takes to thrive in a sector, you can spot small-cap stocks that meet the criteria early. That means buying low and growing big, before others even notice. 5. Build a long-term vision. Solid sector analysis helps you identify companies built for the long haul. The kind of stocks you can hold confidently for years. Major sectors to know: technology, software, hardware, IT services, healthcare, pharma, biotech, medical devices. Financials, banks, insurance, real estate finance. Consumer discretionary, retail, automotive, entertainment. Consumer staples, food, beverages, household goods, energy, oil, gas, renewables. Utilities, water, electricity, natural gas, materials, metals, chemicals, forestry. Industrials, manufacturing, construction, transport. Real estate, REITs, property management. Bottom line, sector analysis isn't just smart, it's essential. It helps you catch trends early, manage risk, and pick stocks with confidence. Master this, and you're already thinking like a pro investor. After picking the right sector, the next thing to check is the P/E ratio, price to earnings. It tells you whether a stock is overpriced or undervalued compared to its earnings. A high P/E usually means the stock is expensive, either because the price has already surged or profits are falling. A low P/E often signals that the stock is cheaper, possibly a hidden gem. Here's the goal: find strong companies with low P/E ratios. But don't stop there, compare it with the sector average. That's how you spot real value. Remember, P/E equals share price divided by EPS, earnings per share. If EPS drops and price stays the same, the P/E goes up. For example, Price equals $20, EPS equals $10, the PE equals 2. If EPS drops to $5 then PE will be 4. EPS drops to $2 then PE will be 10. So, rising PE can mean falling profits. Always watch this ratio, but never rely on it alone. Use it with other indicators for smarter decisions. Bottom line, a good company at a fair price beats a hyped one at a high price. Be smart, stay curious, and invest with confidence. Then comes P/B ratio, stands for price to book value. Price is what you pay for a share, and book value is what the company's worth after clearing all debts. So, the P/B ratio tells you if you're paying more or less than what the company is actually worth. P/B less than 1 is undervalued, could be a good deal. P/B equals 1 is fairly priced. P/B more than 1 is expensive, but hey, don't look at it alone, compare it with others in the same sector. Next up, dividend yield, it's the bonus you get from the company's profit. Higher the better. ROE, return on equity, shows how much return a company gives on your money. Again, higher is better. Also, check the 52-week high and low, aim to buy closer to the low. Lastly, look at the stock graph. If it's rising steadily over time, great. If it's falling, maybe skip it for long-term investing. This is just step 1, reading the stock page. Next up, balance sheet analysis. If you see standalone, it means the report covers just the main company. Consolidated includes all its subsidiaries. For example, in the consolidated balance sheet of Procter & Gamble, you'll find combined financials of brands like Gillette, Pampers, Tide, Oral-B, and Head & Shoulders, all rolled into one report. So, you're looking at a company's balance sheet and wondering, is this a good one? Don't worry, you don't need to be a finance expert. Just keep an eye on a few key things, and you'll start spotting solid companies like a pro. 1. Debt-to-equity ratio, how much debt is too much? Imagine this, a company with more debt than equity is like someone living off credit cards. That's risky, right? Look for a debt-to-equity ratio under 1, lower is better. It means the company isn't overloaded with loans and has more control over its future. 2. Current ratio, can they pay their bills? This one's simple. A current ratio over 1.5 means the company has enough short-term assets to cover its short-term debts. In other words, if stuff hits the fan tomorrow, they can still pay their bills. That's a green flag. 3. Cash reserves, got that emergency fund? Just like you'd want some savings for rainy days, companies need strong cash or cash equivalents on hand. Cash gives them flexibility. No cash? Then any surprise expense could become a disaster. Look for a decent pile of cash on the balance sheet, it's a sign of strength. 4. Retained earnings, are they growing or just surviving? This one's a little behind the scenes. Retained earnings show how much profit the company's kept over the years instead of paying it all out. If it's growing, that means they're reinvesting wisely and building something big. That's what you want. 5. Inventory levels, are they selling stuff or just stocking it? If inventory keeps piling up, that's a red flag, it means people might not be buying their products. Ideally, you want inventory to be steady or moving quickly. A business that sells what it makes. That's a business that works. 6. Book value, what's it really worth underneath the surface? Book value is like the company's safety net. If it had to shut down today and sell everything, this is what it'd be worth. If the book value per share is growing, that's a solid sign the company's actually building wealth. Quick reality check, different industries have different norms. A tech startup and a utility company won't look the same on paper. So always compare apples to apples. Bottom line. A good balance sheet tells you the company is strong, smart with money, and built to last. You don't have to be a numbers nerd, just learn to spot the signs. Once you do, you'll invest with way more confidence and way less stress. Now comes the real treasure hunt, learning how to pick multi-bagger stocks from among the good ones. What's a multi-bagger? Simply put, it's a stock that multiplies your money. If your investment triples, it's a 3-bagger. 10 times. That's a 10-bagger. And today, we're going to uncover the secret sauce to finding such gems, those rare stocks that can turn small investments into fortunes. Here's the truth, just looking at the stock price won't cut it. Many investors fall into the trap of watching numbers tick up and down like a game. But the real winners, the ones who spot multi-baggers before anyone else, do something different. They listen to the story behind the stock. Yes, the story. It's not about what the stock is priced at today, it's about what's really happening inside the company. It's about where the company is going, not where it's been. See, when you don't understand the story, a falling stock price feels like a disaster. You panic. You sell. But if you do understand the story, you stay calm. You might even buy more. Because you know what others don't. Let's bring this to life with a real example, Nike in 1987. Back then, Nike was a much simpler company. They sold sneakers. That's it. So the story was easy to follow. Were they selling more shoes? Were they making profits? Did the future look bright? In 1987, Nike's stock was just $10. Nothing special on the surface. But people were starting to notice something. Everyone was wearing Nike. From joggers in the park to young basketball players. There was something happening. A movement. Then came a rough patch. Sales dropped 22%. Earnings fell 38%. The stock took a beating. Most investors saw this and ran. They thought the company was in trouble. But the story watchers dug deeper. They read the annual report. And guess what? The actual sales decline was just 3%. And future orders were on the rise again. These smart investors understood the business model. They knew Nike didn't need massive factories or heavy equipment. Just a big hall, some workers, a few machines, and boom, they were making sneakers. The margins were great. The company had cash. It was built to bounce back. The price watchers kept thinking it was a sinking ship. But the story followers knew, Nike was still strong. So while others were selling in fear, they were buying in faith. And what happened next? That $7 stock soared to $90 over the next 5 years. A 12x return. A 12-bagger. That's the power of understanding the story, not just chasing numbers. So remember, friends, the story is the soul of the stock. If the story is strong, the price will catch up. Eventually. Your job is to read between the lines, follow the narrative, and believe in it, especially when others don't. That's how you find your own Nike. That's how you discover multi-baggers. And that's how you build wealth that lasts. Now let's zoom out for a moment and look at the bigger picture of investing. First up, new companies. They're exciting. Fresh ideas, energetic teams, and sky-high potential. Backed by investor money and open roads for expansion, they can grow fast, really fast. But here's the catch: limited market reach, fierce competition, and the risk of poor fund management. It's a double-edged sword. Big gains. Possible. Big crash. Also possible. If you're investing here, you can't be hands-off. You need to stay alert, watch every move, and be ready to act. Now let's talk about the middle-aged companies. They've survived over a decade in the market. That means experience, customer insight, and solid banking relationships. Investments here feel safer. But don't get too comfortable, competition can still shake things up. Look at Apple. They bombed with Apple III and Lisa. Meanwhile, IBM was thriving. Apple's stock dropped by 50% in a year. Then came John Sculley. He wasn't a tech guy, but he was a marketing genius. He slashed prices, ran bold ads, and turned the tide. Sales soared. Apple survived, but Steve Jobs got pushed out, and later returned, of course. The lesson? Even the most promising companies can stumble. But smart strategy can turn things around. And finally, the veterans, the blue chips. These giants have weathered decades of change. Foreign investors, mutual funds, they all flock to them. Why? Stability. Even in a recession, they don't crash like the rest. They offer steady returns, regular dividends, and lower risk. Sounds perfect, right? But don't get too dreamy, no company is invincible. Stay smart, stay aware. And one more thing, never ignore the economic climate. Think of it like weather for your investments. Hot economy. People are spending, factories are buzzing, jobs are plenty, but inflation rises, and markets dip. Cold economy. Spending drops, recession may loom, and fear grips the market. Goldilocks economy. Just right. Not too hot, not too cold. This is your golden window. But it's rare and doesn't last long. The economy moves in cycles. So as an investor, timing is everything. Watch the signs. Ride the waves. And always, always, stay informed.